Ability of consumers to service existing credit obligations within the constraints of monthly household budgets. The TransUnion Consumer Credit Index, or the CCI, to be released today, says consumer credit health remained under stress in the fourth quarter of 2013. This was a slower pace than in the previous 4 quarters, which was an indication of difficult financial conditions. Well, here to unpack the report for us is the CEO of TransUnion, Geoff Miller. Geoff, welcome. Good to have you on the program.
Good morning. Thank you.
All right. So the interest rate hike that we saw this week came as a bit of a surprise to you as well.
Yeah, I think if you looked at the survey prior, 25 out of 25 economists did not think that there was going to be the interest rate hike, and obviously the Reserve Bank felt it was time to do something.
Yeah, indeed, time to do something. But let's talk about now people that are having problem and their credit health isn't so good. This is not great news for them.
No, it's not great news. I think on the back of e-tolls, the interest rate hike, plus I guess the fuel increase, I think of 55 cents per liter. Those consumers that were kind of living on the edge and basically just making ends meet, these types of things could well put them over the edge.
Yeah. Well, we were chatting a little bit off here and saying that this is the first time in 5 years that we are seeing the trend of interest rates going up now, because they've been going down.
Correct.
And yet our health is not better.
Yeah.
So this is a worrying situation, whereas perhaps a year and a half ago we were looking a lot better.
Yeah, we were certainly in a better position, but economic and job growth has been anemic, and so I think consumers are under stress. They remain under stress, and the interest rate hike is especially going to hurt consumers that have mortgage bonds and vehicle loans, because those interest rates are going to rise up and their monthly repayments are going to increase.
Yeah, indeed they will. Let's just talk about the report. What are some of the findings that you'll be talking about today?
So the index is below 50. It's around 47. Anything below 50 means consumer credit health is deteriorating. So basically what we're seeing is delinquencies are up, so 8% in terms of number of accounts that are delinquent or non-payment accounts on a year-over-year basis. Consumers are using credit cards and other short-term debt to pay their day-to-day bills. I think inflation was a little bit muted in Q4. I think that surprised, but given the depreciation of the rand and fuel levies, we think that's going to turn the corner in Q1 in a negative direction. So what we're basically saying is consumers are under stress, and especially in the low LSMs.
Yeah. How is it calculated? Because the CCI, it's quite a unique indicator of consumer credit based on a 100-point scale.
Correct.
So how does it work? Where do you get the information from?
So we maintain information that we get from all the lenders around who they give money to. So we have a very good idea of which consumers are under stress and how under stress they are. And then we look at macroeconomic factors like debt servicing cost, and we look at household cash flow that looks like money in the system as well as inflationary pressures. We kind of put both of those things together to come up with the index. Once again, below 50 means things are not going well. Above 50 means consumer credit health is improving.
All right, so just to put it in layman's terms, and for viewers that are watching, what does this report mean for us? What should we take out of it?
I think, especially given the interest rate hike, I think consumers need to be very, very vigilant around additional debt that they take out. I think they need to look at their monthly budgets. Costs are going to be going up. So they need to make sure that the money that they have can support the basic necessities that they have, as well as the debt that they need to service. So, consumers need to be very cautious around taking any incremental debt.
All right, so that's a lesson to be learned. Do not take any more debt. Why are we distressed, though? Because, yes, I know the cost of living is getting higher. I mean, you mentioned e-tolls, you mentioned the petrol price. We look at food costs. I mean, I was having a look now, quite interestingly, ginger, of all things, has gone up 300%. I mean, I'm not saying that that's a staple diet, but that's the reality of how things are looking.
Yeah.
Things are getting more expensive. We're trying to pay off our debt, but salaries are not necessarily moving in line with this, and the unemployment rate is not exactly getting any better for us. So how do we as a country get out of a situation like this?
It's going to be difficult, and it's going to take some time. I think, but it all comes down to job growth and economic growth. I think the U.S. GDP just grew unexpectedly strong. There's some weakness in China, but South Africa needs to find a way to accelerate the growth. And with growth is going to come jobs. So I think consumers need to tighten up. That's going to help. But I think overall economic conditions are going to have to improve for the broader economy and the broader consumer base to be better off.
All right. Geoff Miller, thank you very much for talking to us. I imagine the report will be on your website?
Yes, transunion.co.za.
Okay, there you go, transunion.co.za. If you'd like to read it, it is being released today, so you can get out there and take a look at exactly what it says about our credit health here in South Africa.